bunch of what we call stuff or clutter. Just some general topics that come up on a consistent basis that we feel like it's just appropriate to review those. The first thing I happened to notice today was when I was looking at the people who had registered for the webinar, quite a number of you are not using the Axia Partners email structure. So it's not like, maybe you're not using like larry.newworth@axiapartners.com. You might be using your home email. And if that home email is the email that Mutual of Omaha has on file, that's okay. But where it's going to be awkward for you is when you write a case and it's going through underwriting and there are outstanding requirements, or the case manager is sending you updates as to where that case stands during the process. That's going to come to you through a secure email. That is not a pleasant experience to go through. However, if you do use your Axia Partners email regimen, there's a security handshake between Axia Partners and Mutual of Omaha where the emails you receive are not secure. So that's just a heads up for you. It's happened a couple of times recently to a couple of you out there in the field. It's frustrating for you, I understand that, because they're a pain in the rear to get that secure email going correctly. So just a heads up. So if you are using your home email address as opposed to the Axia Partners, strongly suggest that you reach out to either us here at AIM or our counterparts at Golden Care up in Minnesota to have them change your email address in the system. You can also have the email address changed by the case manager on a particular case as well. They can change it on the fly. Just a little observance we've had here lately, and just want to bring it to your attention. Some of you may have already experienced this. Mutual of Omaha just recently made an underwriting change, mainly with the pre-qualification process. If you've called that toll-free number for the last week, you'll get a recording that you are now being asked to send an email to ltcunderwriting@mutualofomaha.com. They've just hired 3 new underwriters, and they're in the process of training those underwriters, so they're not live on the line yet. And Alan Gregoire made the decision to pull the people off the phones to focus on issuing business and training these new underwriters. We hope it's just a temporary thing. We don't like it at all, but we still have some remote access. So if you get into a bind, give either Mike or I a call. We have some backdoor things we can work some magic for you. However, they are quickly replying to any email requests that are sent for pre-qualification to that ltcunderwriting@mutualofomaha.com. I did my first one a couple of days ago and heard back within 5 minutes of hitting the send button. So it's not like it takes 24 hours to hear back. It certainly would be a next day reply if you submitted a request pretty late in the afternoon. So temporary thing, we hope, but we're also hoping that they'll be back live here pretty soon as well. So just a little plug here for the electronic app, the e-app with Mutual of Omaha. If you have not yet established a login ID and password to mutualofomaha.com, we strongly encourage you to do so. We are seeing an uptick in the volume of business that Axia Partners is writing using the e-app. I have not talked with anybody at all that has had an unpleasant experience doing this. In fact, for most of you, it's been a rather pleasant experience, especially the signature process. Once you have established a login ID on mutualofomaha.com, this is the landing page for what they call sales professional access. You'll hear the internal people at Mutual refer to this kindly as SPA. And right on the landing page, right here on the very first page, is the link to click on to go to the e-apps. And it starts off with the MedSup, but if you just scroll down right below the Medicare Supplement e-app, there's the long-term care e-app. Here's the sandbox you can play around in to get a feel for the flow of the application and experience what the signature process looks like without doing a live app. And then once you have created some applications, they will stay up. You can go back. It's automatic save and close. If you get partway through an app, e-app, and your client has to break away that appointment, they run out of time, you just walk away from the application. Everything you've input is saved automatically, so you can jump back on that application and complete it when it's convenient for you and or your client. Strongly encourage you to look at that if you have not already. The rest of the time, I thought I'd just spend some time walking through or walking around some of the nuances of some of the benefits available with Mutual. Mike earlier, over here in the toolbar, put up some handout material. You can grab their PDFs. One is the product and underwriting guide for Mutual Care Solutions, which is also right here in the software. If you do run the standalone version of the software, a handy reference, you can open that Word document right there and scroll through to the impairment guide. Or if you have a question on how a particular benefit works with Mutual Care, the product guide is in the front part of that booklet that tells you exactly how each of these benefits work that are either built in or available as riders. The portfolio overview PDF just shows you the differences between the secure package versus the custom package. We also put up there the state variation chart that shows how the benefits may vary. In some states, it's not always the same. An example would be on the Share Care rider, where in the majority of the U.S., the rule is there's a 1-year holdback. I believe both New York and Arizona, if you looked at that state variation, you'll see there's a 2-year holdback requirement in those states. Those little nuances are covered in that handy reference for you as well. The most important document that's up there for you to grab, it just happens to be Nebraska, but it's a sample policy with all the riders attached to it. If you don't have the sample policy and the riders for the states where you're selling, you should have them. You should understand that policy inside and out. That way you should feel confident as far as telling your clients and your prospects exactly how a certain benefit can be taken advantage of in the Mutual Care Solutions product family. We also would expect you to have the brochure memorized, so you can, if a client brings up saying, basically ask, how does a Share Care rider work? You can tell them to go to the right-hand column on page 3 of the brochure. Is a nice little English language explanation as far as how that benefit works. But questions that come up all the time, non-forfeiture. Even with people, this is probably a phone call that I take at least 3, if not 4 times a day with agents asking me if I could explain what the non-forfeiture, and they're not even sure what this SBP stands for, and it stands for shortened benefit period, rider does, versus the contingent non-forfeiture rider benefit that's built into the policy. You have to really understand how that non-forfeiture works, because your client has to reject it if they don't want to buy it on the application itself. So there are 2 triggers for the non-forfeiture benefit. One is built into the policy, one you buy as a rider. The one that's built in is called contingent non-forfeiture, and that's a consumer protection vehicle that has to be in every long-term care policy that you sell, regardless of the company, and it's been there for as long as I've been here, and it's been 16 years. If the company were to come into your state and file for a rate increase or rate increases that over time total up to be deemed substantial, and how they define substantial, if you recall, there's a chart in the outline of coverage that shows the rate increase percentage increase based upon when you bought the policy. If it exceeds that number, then you can exercise what they call your contingent non-forfeiture benefit. Call the company, cry uncle, stop paying premium at that time. Mutual of Omaha would consider your policy at that time to be paid up. Your monthly benefit will be whatever it's grown to with inflation, but your pool of money you're drawing out of at claim time is going to be limited to the premium dollars you paid in. So you will get your money back out of the policy when you claim. The one you buy as a rider, the benefit's the same as far as getting your money back out of the policy at claim time, but what triggers it is that the policyholder at some point in time after the 3rd policy anniversary walks away and lapses the policy. They'll get their money back out when they do claim. So that's the difference between the built-in non-forfeiture and the one you buy as a rider. In all the time I've been here, I have never seen a policy issued with that rider in force, but when you do, if you do have a client that wants to buy that rider, it basically replaces the built-in contingent non-forfeiture. That comes up all the time. Right below that is the 200% professional home health care. First reaction when people see that is they feel like they have to buy that, otherwise they will not have professionals covered under the regular home health care benefit. That's erroneous. The regular home health care benefit with the mutual policy covers all level of care coming into your home, whether it be an independent caregiver benefit or through a home care agency. RNs, licensed therapists, CNAs. What qualifies as professional are the RNs and the therapists, like a chemotherapist, physical therapists, occupational therapists. Those are all what they consider to be professional. If you buy the rider, that 200% professional rider, what it does is on those days that you do have an RN coming in, along with the CNA, your daily benefit for that day will double. So if your policy benefit was $4,500 a month, they break that down into a daily benefit of $150. So for that day that you had the RN come in, your reimbursement amount for that day would be up to $300 for that day to cover all the expenses for everybody you had coming into your home. It's a limited benefit. It's very inexpensive because there's a 365-day life to that benefit over the course of a claim. And it also draws the money right out of the pool. So it will draw your pool down quicker if you are taking advantage of that rider and incurring expenses that exceed the regular, for example, in this case, $4,500 per month. So that's what that rider does. The ROP options, return of premium. There are the basic rule for all three of these options is that you have to be under the age of 65 to buy it, any of them. So there are three flavors. And they all return premium upon death. The first one, and the first two actually are fairly inexpensive. The first one being if death occurs prior to age 65, all premiums are returned that were paid in minus any claims paid out. Again, death has to occur prior to age 65. The second would return 3 times whatever your initial monthly benefit was for the policy. So if you bought a policy, it was $4,500 a month, and you pass away 25 years later, Mutual of Omaha will write a check back to your named beneficiary or to your estate for $13,500 minus any claims that may have paid out, and that's how that rider works. Again, fairly inexpensive, but it's always whatever the original monthly benefit was, not what it has grown to with inflation at the time of death. The last one is the spendy one. This is going to be, again, return of premium, death at any age, all premiums paid in minus any claims paid out, and that's when it's going to carry the larger price tag. The 3 times MMB and the less claims option are not available if you bought Sharecare for a married couple, and the software will tell you so. The only ROP available for a married couple with Sharecare is if death occurs prior to age 65. Additional discounts. We get this question all the time. Are there associations that we can write into that people can get a discount? Or my client is a member of XYZ association, does that qualify for a 5% association discount? Not necessarily true. Just because your client is a member of an association doesn't make them eligible for an association discount with Mutual unless that association is already established with Mutual of Omaha and is available for you to write into. The most recent association that just got approved that you have access to is the NRA, and that will be a case if you have somebody who's a card-carrying member of that association, they will qualify. They and their spouse, if they're both applying, would qualify for that additional 5% discount.
Hey, Dave, one thing I want to point out, sticking with the discounts and associations, and we do get this a fair amount, just because another competing agent tells your client they can get them an association discount doesn't make it so. The playing field is level for this. If we call up and we're trying to find out whether the left-handed green-eyed Seroptimus of Suffolk County is an approved association, if we come back and tell you no, they're not, which means that whatever this other agent is telling your client may be somewhat less than accurate or truthful. So just be aware that there are no secret groups, and there's not a secret handshake and all these other kinds of things. We have access to all that information, and the playing field is level. So if we come back and tell you such and such doesn't exist, it doesn't exist. In terms of how you break that information to the client, it's a different story. But we just want to make sure you know that there aren't secret deals out there. They may be restricted, and you can't write into it. But if it exists, we'll be able to find out information and get that information back out to you.
Yeah, thanks, Mike. And there are those scenarios where an association may be an approved association with Mutual of Omaha, but it could be an exclusive to another, what they call a marketer, or it could be exclusive to mutual career agents for that matter. But if you come across a potential and you're not quite sure, call us. We can make a simple phone call to find out if that association is indeed approved. Oftentimes they'll come back and say, yes, it is approved, and any agent can write into it. You just can't market into that association. So you can pick up onesie-twosies here and there using that discount as well. The last thing I wanted to cover mainly here is all the inflations. People sometimes get confused as to what the buy-up means. And what do you mean by these caps? I'm not sure what these caps are. Well, the buy-up, we'll start with the buy-up. And it's only available on the custom package. It's not on the secure whatsoever. But basically, if you purchase a policy with inflation protection that is something less than 5%, the software always defaults to 3%. 3% is the new 5%. We all know that. But in a lot of cases, you can actually, we've seen a number of policies issue with just 1%. So if you start off at 1%, and say you're 55 years old when you buy the policy, and when you turn 60, just as an example, and your income changed to the point where you feel like you can afford to pay a little bit more money for your long-term care policy, you're not quite sure that 3% is a big enough number to keep up with inflation at that time, you could request on your policy anniversary that Mutual increase that, say for example, from 3 up to 4. Two things are going to happen. One, there's going to be no underwriting. That's a guarantee issue, upgrade. And secondly, you're going to pay basically an attained age rate for that 1% increment that you added to your policy. And you as the policyholder can do this. You can make these moves up or down on your policy anniversary as many times as you wish for either the first 20 years of owning the policy or to age 75, whichever comes first. So if you sell it to a 70-year-old, they're only going to have 5 years to exercise that option. Now, truthfully, we don't see a lot of people doing this, but here's one scenario where someone would potentially take advantage of this. If you have somebody who gets an early onset diagnosis of Alzheimer's, say at age 70, and they've had this policy now running at 3% for the first 15 years of owning it, it would be a smart move on that person's behalf to immediately jack that to 5% compound. And that way it's going to continue to grow at 5% compound forever, or to whatever cap length they have if they elected to cap the growth of the inflation. That's one good example of where somebody could take advantage of the buy-up when it really does matter down the road. Now, the different caps. In all states, you can cap the inflation growth at 3 different levels. You can have it stop growing at the 20th anniversary, or the 15th anniversary, or the 10th anniversary of the policy. So whatever your inflation growth is in year 9, that's going to be the inflation growth you have in place when it stops growing, and your policy basically is going to be frozen at that benefit level from then on, whether it be after 10 years, 15 years, or 20 years. Where these options come into play, we normally age band them. If you're working with people in their 60s, say 62 to 67 or 68, you might take a serious look at the 20-year cap. If they're up pushing 70, you might take a look at the 15-year cap. If they're more senior yet, you can take a look at the 10-year cap. It's a way to save some money on the premium, and it also gives them good growth until their quote-unquote expected claims age. So it's just another option that you have that's unique to Mutual of Omaha that allows you to kind of squeeze that nickel when it gets important to save money for your clients who are looking to buy a policy. So I hope everybody understood that quite well as far as how the different inflation options work. When you're potentially looking at reducing the assisted living facility benefit or the home health care benefit. You know, I normally recommend never doing that, because that way your client knows that their policy is going to reimburse them $4,500 a month regardless of where they receive care. But on the home health care reduction option, if you reduce the monthly benefit for the home health care, you're having a direct impact on what the cash benefit is of the policy, because these two are related to each other. The cash benefit is always 40% of whatever this benefit is here. With an just the only caveat to that would be the initial value of the cash benefit cannot exceed $2,400 a month. So if I reduce this down, for example, down to half, you'll see that my cash benefit went from $1,200 each to $600 each. So just keep that in mind. Just be careful if you ever consider that reduction in the home health care benefit. Mike, I think we're at a point where we could start opening up some lines. Did any questions get typed in at all along the way?
Just one, and as it turns out, you were answering the question at the same time as he was keying it in.
Okay.
So we were able to handle that. It wasn't, you were handling it globally, so we didn't need to interrupt or anything.
Okay. Okay.
All right. Well,
as we unmute you, would you please make sure that your speakerphone is off, or you have your phone muted? We don't want to have any background noise if at all possible, please. Okay, we've got just about everybody unmuted. Now is your opportunity to ask either Mike or I any questions you may have about Mutual Care Solutions. No questions? You've got to be kidding me. Okay, everybody is super confident that they understand how this product works, how the little nuances are with non-forfeiture, the professional home health care benefit, the different ROP options, the inflation, how that works with a buy-up. Everybody's cool with all that?
Quick question on lifetime inflation.
Yes.
On my software and the clients in the state of Wyoming, it does not offer the 20 years, so I'm assuming lifetime, and I can tell him that inflation option is there beyond 20 years?
Let's go to Wyoming. First of all, if you're quoting partnership, remember there's different rules with partnership, and that varies state by state, and the rules are right here in the software. But with Wyoming approved, like for example, the 20-year compound is approved for anybody who's 56 years old or older in Wyoming. The lifetime compound obviously is for 30 years, you know, from the youngest age all the way forward, all the way down to 1%. The 15-year cap kicks in at age 61, and the 10-year cap kicks in at age 66. So what was your software doing that was not allowing you to quote something?
Male, age 48, and when I click on 20 years, it shows up yellow and acknowledging that it's not available, or I'm doing something wrong. Not sure. But
no, it means you have the partnership button here in the software on the lower left-hand side turned on. Yep. So that is that 20-year cap is not eligible for partnership for someone who's 48.
Okay.
The 20-year cap, the 20-year cap comes in at age 56. So if you were just to go down the lower left-hand corner of the software and turn partnership off, you're fine.
What will that do for partnership? I mean,
it means that policy is not partnership compliant. There's no asset preservation at all in that policy.
Okay. I want him compliant, so we will leave it on, and you've given me the answer that I needed. Thank you.
You're welcome. Any other questions? Everybody's good? Okay, then don't forget we have those handouts for you, the product and underwriting guide, and keep in mind it's in the illustration software as well. The portfolio overview, which will give you the differences between secure and custom. There's a sample policy there from Nebraska, and then the state special matrix grid that kind of gives you the nuances of each state in case there's any variations in any particular type of state. Those are all handy quick references you should keep close. I encourage you if you haven't already, to go start playing with the e-app. Like I said, every one of you that have used it so far, enjoy the experience as much as you can enjoy the experience of writing a long-term care application. But it flows well, it saves well. We check the site 4 to 5 times a day looking for anything that's been submitted to us. We turn it right around and submit it to the home office. So it's pretty quick about getting in. It does knock 3 or 4 days off the processing time. And at least you know the application going in the door is complete. It may be wrong, but it is complete. All right, Mike. Well, from Chicago, Mike and I wish you folks to have a wonderful weekend. Let us know whatever we can do to support you during Long-Term Care Awareness Week. We're down to the last 2 months of the year. Quite a few of you are at or close to that $1,000 bonus for submitting $100,000 worth of business with us. Whatever we can do to help you help push you over the hump to get into that, we're here for that, and we'll do whatever is legally allowed to do to get you there. So thanks again for taking the time to join us. Everybody have a great weekend. Take care.
Thanks, everybody.